Hey, welcome back to Everything Money. In this video, you will learn about Apple stock. Christmas season is here and they're implementing new COVID restrictions in stores. For our 400 subscribers, we get a day, new subscribers, we get a lot of requests for this stock. We'll show you the financials of the company and we'll use our 8-pillar system on how we look about analyzing a company. We'll show you what you should be paying for Apple moving forward using our stock analyzer tool. And if you want to trade this stock at a quicker pace, you will join Mo at the end of the video who'll show you all the charts and trends where you can make money on these swings. But first, why should you watch this video? I bring your questions about this tech giant Apple to a couple guys that own over $100 million in real estate, multiple businesses and stocks, and they will provide us with a mindset and an approach on how to invest in a company like this. So I introduce Paul and Mo as always. Welcome, boys.
So Apple, it gets a lot of attention because Warren Buffett and Charlie Munger own shares in the company. They started buying. When did they started buying Apple?
Ooh, I don't. It's been a while. I don't know the exact number. You want me to look it up?
It's been a hot minute. Yeah, look it up. I always tell the story about Apple. 6 or 7 years ago, there was a guy who was working for me who was the biggest Apple fanboy in the world. And it was funny because he came to me one time and said, "Hey, what do you think about Apple from a fundamental standpoint?" I think at that time it was selling for like 9 or 10 times earnings. And I was like, listen, fundamentally, it's a screaming deal. And at the time, I remember saying, the issue I have is it sustainable? Is the growth sustainable? So let me share my screen. Seth, can you bring my screen up in here?
Yeah, go ahead.
Let's go to our exclusive Everything Money software. Let's look up Apple.
2016, Paul.
That's when they bought Apple?
Yep. That's when they started their position.
So around 2015, I think is when the guy is asking me, and look at their revenue growth since then. I mean, it's definitely has sustained and increased. Look at their profit, 53 billion and 95 billion. So my biggest concern was in technology, especially, people's whims can change very quickly. That was 7 years ago. At 2015, it was only 8 years after the first iPhone came out, right? Wasn't the iPhone first in 2007, Mo?
Yeah.
So that was a very scary thing to me. And I just looked at it going, okay, the fundamentals make a lot of sense. But if all of a sudden some other new player comes out there and creates a better phone or creates this, we have a problem. Now, we're 15 years in the iPhone. We're 15 years in the iPad, or whatever the number of years in the iPad. The company is a lot more ingrained in our lives, and they're doing a really good job of making sure that when you have Apple products, you stay within the Apple family.
Yeah,
and I think that's what was that, Mo?
That's absolutely correct. They've created that quote unquote ecosystem, because I remember in it was probably around 2016. I tried to switch to a Galaxy for 6 weeks. It ruined everything. I mean, my iPad didn't sync, my computer didn't. It was terrible.
Didn't you go see a therapist?
Yeah, he did. Yeah. Paul, I feel like maybe like 5, 8 years ago, there was this phrase like, don't drink the Kool-Aid with Apple. And I haven't heard that in a while. Now everyone's got it. We all got the iPads. It's not really a trendy thing anymore. It's just like really ingrained in our lives. So
it just is.
Right. So let's do our 8-pillar analysis. What do you guys think?
Go ahead.
Yeah, let's do it.
So here's the stock. Here's 10 years. Mo told me to buy it 10 years ago, even though I didn't know him back then at $13. Now it's 175. So look at this. This PE is 30. Like I said, back when the person told me to look at it, I believe it was 9 or 10. I don't remember exactly off the top of my head. So first pillar is we want the 5-year PE under 22.5. It is expensive. It is 45.76. Now, does that mean the company's expensive? No. You should be willing to pay a higher PE for faster growing companies. So we have to look at the growth and make our assumptions later in our software. But number 2, we want the 5-year return on invested capital greater than 9%. It is 30.3%.
That's more, I think.
This means, yes, this is more. They do a phenomenal job of investing the capital in the business. That's through debt and equity. Pillar number 3, we go to the income statement in our exclusive software. We want to see revenue growth over the last 5 years. So 229, 365. Now, Seth, what's something you see in this that I always bring up when it comes, especially as of late, when it comes to revenue and profit?
Well, I was going to say going back a decade, I see a nice growth maybe until COVID, right? Or until this year. Like that's an explosive growth, right?
Yes. So I wonder, is this sustainable? Because we had pretty moderate growth here. I mean, 5%. We had a dip here actually. So, and then all of a sudden we have a massive jump in revenue here. That's always going to make me go, okay, is this sustainable? My question is always going to be on companies like this, is this sustainable? Fast growing companies, you have to question the sustainability of the growth.
Paul, you've taught me as a business owner that, I think everyone wants fast growth, lots of users, lots of YouTube subscribers. And you've always said, well, no, slow growth is better for me. I'm thinking, why could that be? But you're right.
I say, yes.
Consistent
growth.
Yes, because a huge growth spurt up can result in one that goes down. It's more susceptible to going down. And so I can now understand, say you're loving Apple after this huge growth. This could be one of the companies that fall if there's a recession, right?
Maybe. I mean, who knows? But the goal of us being investors is to be conservative in our assumptions. And there'll be people out there who probably say, oh, look at this massive growth here. Let's project that out for the future. If you think that's crazy, I've seen it 1,000 times. So anyhow, pillar number 4.
Yep.
We want profit growth the last 5 years. So we scroll down on our exclusive software, $48.35 billion to $95 billion. I mean, almost double. But again, look at this.
Then again, yep. Look at those 4 years. Yeah.
I mean,
nice,
we have
consistent growth.
Well, I mean, it's actually pretty stagnant here. If you look at these 5 years, and then all of a sudden, kaboom.
Yep.
So,
wow.
Okay, just something to consider there. I just, I don't know what this means necessarily. It doesn't say Apple's a good investment or a bad investment, but it's just something to keep in mind. All right. Pillar number 5, which is probably something that I think appeals to a lot of people. We want to look at the shares outstanding. We want to make sure the company is not diluting their owners by issuing more and more shares. Now, Apple is expensive, so issuing shares makes sense. But we want to look at their shares outstanding and see, are they diluting you as an owner, or are they giving you a higher percentage of the company by taking away shares from the market? So we go down to the bottom of our income statement. 5 years ago, 20.6. Today, 16.5 billion shares. So this company spits off so much cash, it's hard to reinvest that cash at higher returns, right? When you're making $50 billion, it's really hard to reinvest that money a really high rate of returns. So what do some companies do? They buy back shares. Now, one thing I don't like is the company's expensive, theoretically. So buying back shares is not a good thing to do necessarily, but we'll see. Okay. Seth, can you please explain pillar number 6?
Yeah, pillar number 6 is our looking at their debt. If there's a recession, can Apple survive? How much money do they owe? How much money do they have in free cash to pay it off? Paul, let us know.
Yeah, so like Seth said, just like your personal life, the more debt you have, the more likely you are to go bankrupt when bad things happen. So companies that stay around a long time tend to have lower levels of debt. So what do? I go to the 5-year average free cash flow on the main page of our exclusive software. And I multiply this bad boy by 5. So 68 billion times 5 is $340 billion. So then we go to the balance sheet of our exclusive software. I want the total long-term liabilities to be under $340 billion. We scroll all the way to the bottom, $162 billion. So less than half.
Half, yeah, nice.
Yeah. So this means if they mimic the last 5 years of free cash flow for the next 5 years, they could pay off all their long-term liabilities in 2.3 years, 2.4 years, something like that. That's incredible, right?
Yep. Pillar number 7 is the lifeblood of the company. You always say, you started saying this a couple months ago, and I really like it, but it's free cash flow, cash from operations minus capital expenditures.
Correct. So there are 5 things you can do with free cash flow. You can buy back shares, you can pay dividends, you can pay down debt, you can make acquisitions, you can reinvest back in yourself. This is what an investor is going to use to get their money back, right? So cash from operations, we go to the cash flow statement on our exclusive software. We go to cash from operations, and we have the capital expenditures. But your Uncle Paul has done something very nice. I added this line here to every cash flow statement. That way it does the math for you. So $51.77 billion to $93 billion. Check mark there. So final metric. We take the 5-year average free cash flow. We multiply by 20. Why 20? It's a starting point, folks. A little bit better than the PE. We want to get a starting point for market cap. Doesn't say buy or sell. It just says here's a starting point. So 68 billion times 20 is 1.3 $1.36 trillion. So we want the market cap under 1.36 trillion. We go to the metrics page.
Oh boy.
And it's $2.9 trillion. So over double that amount. So that's an X. And just for those of you who don't like the math, here's the 8 pillars tab of our exclusive software. Seth, this is what we love seeing, right, Mo?
Yes.
Yep. Love this.
So this to me tells me, okay, Apple might just be overpriced. Let me be cautious. Let me just keep it on my radar. But we're going to use the most exciting part of our software, the stock analyzer tool, to look at the growth rates and make assumptions, because every investment is the present value of all future cash flow, right? So our goal is to make assumptions about the future, and it'll tell us what we want to pay for the company today based on those assumptions.
Paul, I couldn't help but notice that that disgusting Band-Aid on your thumb. I assume that was a tragic nose-picking accident?
No, I don't hurt myself when I pick my nose. This was actually when I was falling asleep last night. I felt a little skin. I felt this little skin on the end, so I started biting it. All of a sudden, it started bleeding. I don't know if there's blood on my sheets right now. So
wouldn't be the first time, Paul. Okay, let's get after it. Stock analyzer. Go ahead.
The first time was a dead hooker, but all right. So years of analysis.
I don't think that was supposed to go on
air. 10 years of analysis, and we're going to do 3 assumptions. Now, guys, what this does is it gives you the last 1, 5, and 10-year annualized numbers for all of these assumptions, and just ask you to give your own assumptions. So, Mo, give me your insane assumptions for Apple, since you're an Apple fanboy.
What about 468?
Oh my God, I love it. I'm actually falling in love with Mo every
second. Hold on a second. I got to stop you guys, because I see some comments and people are like, what are you two talking about? Look, it's 33% revenue growth. Why would you put 4 down? You're stupid. 4 is stupid.
So I'm looking at the 10-year. I did, right before Paul started this, I just went to see, were there any acquisitions? So was this organic? Pretty organic. They made it $1 billion acquisition. That's pimple on their ass. So this, to me, I think that their subscription is going to be, their subscription-based company is going to be bigger than Paul does. I think it's going to work better. That's correct in saying, right, Paul?
I mean, you're saying, yes. I mean, I think it's going to do, I think that's the future of all these major tech companies is a subscription business. I do agree with that. But why'd you go so much lower than most people would but more lower than I thought you would go? I thought you were going to tell me, 7, 9, 11 or something.
Yeah, well, they just surpassed being a $3 trillion company the other day. I mean, they're back below $3 trillion now, but I mean, what do they have to do to go bigger?
We're talking about we're just looking at the revenue growth right now. Like that focus, don't look at the market cap. And folks, a lot of people do that. Just focus on the revenue part. Like, why'd you pick 4, 6, and 8 for the revenue?
Well, I mean, talking about where can they exactly? It's not like they're coming out new products right now. I don't really see how they can grow in revenue unless they come out with the subscription thing. So I'm going to be conservative and say, let's say the subscription thing isn't as great as I think. Let's tailor it back a little bit.
So I agree with Mo. My goal is to be conservative in all my assumptions. This is already a company that did $375 billion last year in revenue, which is a huge jump from the year before. So if they take a step back a little bit and then grow 7 or 8%, they still are going to overall do 4, 6, 8%. And our goal is to make conservative assumptions and find companies that are selling for below those conservative assumptions.
Right. And let's say worst case, I'm going to compare it to the Alibaba. Let's say Alibaba's doing 30% revenue growth now. Let's say they go to 10. Well, I still like it at 10. So let's see if I like it at 4.
Yep, I agree. All right, so profit margin, Uncle Mo.
I think it could stay very similar to around that 22.5 number, but if the subscription-based business gets bigger, that could certainly increase. So why don't we go 21.5, 22.5, 23.5?
Love it. Okay, free cash flow margin.
Let's do the same 24.5, 25.5, 26.5.
Love it. PE. Here's where everybody's gonna be like, "You're stupid, Paul. You're dumb."
Let's go 14, 16, 18.
I don't disagree. And same with free cash flow.
Yes.
And guys, we always do 12.5% desired annual return. Why? Because you can invest in an ETF and get 9 or 10%. So in order to invest in individual stock, do 12.5%. Gives you a margin of safety. Gives you a reason to get up in the morning. We hit the analyze button. Okay. Here's the stock price, guys. It's showing us overpriced in all areas. It's a range of 61 to 70 on the low side, 80 to 90 on the mid, and 100 to 115 on the high. So this is just telling me, hey, if I want a 12.5% return, I got to pay between, based on my assumptions, probably around 80 or 90 bucks a share, which is half what it is today. Which, by the way, the PE is 30, historical average is 15. Cut that in half. What does it make it?
Yeah, and it's consistent with. I started selling puts on this at 120, so it's very consistent with what numbers we've come out with before.
Yes. So, guys, this stock analyzer tool we created, and it's been so popular in our software. And the reason we created the software was because we had so many users that were making videos before that would email us or message us and say, how do I analyze these companies before you do? Because we can't wait around for all those videos. So we made the software. This software includes everything you've seen already, includes everything that's coming out here on the main page, all the exclusive content, everything. It includes 2 or 3 videos a day of exclusive content. It includes the 8 pillars and 30 years of analysis. It includes access to Seth Moe and I. It includes the real estate calculator, which is a way for you to analyze real estate deals. It includes all of this and all the growth that's coming from it. But most importantly, most of the people who watch our channel feel alone in their investment journey because they have these thoughts that make sense, but all their friends are all the Tesla fanboys of crypto, and they don't talk about fundamental analysis. So they feel like the community of over 6,000 people in an organized chat where they can have discussions with everybody around them about every single topic in so many different chats, discuss their investment ideas. Thousands and thousands of messages are exchanged every day to discuss investment ideas. And all of this is available for only 90 cents per day. Less than a cup of coffee. You can have all the software. There are 2 ways to sign up. Just go to everythingmoney.com or Patreon. The benefit of everythingmoney.com, though, is we are not big enough yet to charge sales tax. You're going to save that sales tax for quite a while. So again, guys, 90 cents a day. You get everything you saw in the video, plus all the extras that are coming out and the exclusive content in the chat and everything. Sign up now.
If this resonates with you, you can have the software and you will love it. If you want to trade Apple at a quicker pace, Mo, show us the charts. We've had people go from not knowing anything about investing, Mo, to 6 months later, they are trading actively with you on a daily basis. Show us Apple, babe.
So right now, Apple's actually part of the Employed Trader series. I'll speak about that in a little bit. But this is a stock where when you catch a long-term trend like this, that you can actually stay in it for a very long time. So this is a great stock to trade from both a long-term perspective, swing trading perspective, and day trading perspective. So right now on Apple, we're starting to get, we have hit all-time highs around this 183 number, and it's pulled right back down. So this is nothing but a snapback. I say that because your long-term trend is still up, but your stock price is pulling down. So see what happens there. Be patient with this. If it makes a new high, if it breaks out an engulfing candlestick to a new high, go for it. We have been making money in the Employed Trader series over here in this little swing trading channel. As soon as this thing started popping up right here, good consistent volume, clear of moving averages, we have caught this entire run from 162 to 184. We were taking profits around 178, something to that regard. And we're just going to wait. If we get a breakdown and engulfing candlesticks down, we can short it down to the 25. Or if we do break out to new all-time highs again, we can jump in it there. If you want to day trade this, it is a good one to day trade because you consistently get movement every single day on this stock. It's not the best thing to trade from a day trading perspective, but it suffices. So what you would do over here, I'm going to use yesterday for an example. As soon as you get over 80% on your long-term stochastic, that is when you wait for an engulfing candlestick and you make this run up, capitalize. As soon as it drops below 80, that's when you sell. So there's 3 different ways that you can approach this. So if you like these rules and if you like this process of trading and you've never been able to do it before, come and join me in the Bid and Ask Nation. You get the Employed Trader series, which is 6 stocks that I go through every single day, including Apple, and I alert you when we make money together. You get the Trading 101 series, which is all of my rules for any type of trading that you want to do. You get my monthly Saturday seminars, and you get a Discord community of 950 plus people that are all in the same boat as you. Come and join us.
That is our take on Apple. Fondle a thumbs up on the way out. We will keep you updated. One of our favorite companies. At the moment, we think it's an overpriced stock, but when it falls into our wheelhouse, Paul, we will certainly be buyers of Apple one day. So that's our take. Thanks for watching, guys. See you next video. Appreciate it.